All right, today we're going to do something a little different. We're going to become financial detectives. Our mission? To figure out if a company is healthy or not. And our clues? Well, they're all hidden in the numbers.
I mean, this is the big one, isn't it? For anyone looking to invest. You see a company, it looks good from the outside, maybe the story is exciting, but how do you really know what's going on under the hood? How do you separate the next big thing from a total disaster just waiting to happen?
Well, here's the thing. The secret isn't some big conspiracy buried in a vault. All the evidence you could ever need, it's sitting right there in plain sight inside a company's financial reports. You just have to know how to read them.
Okay, so let's get right into it. The best way to think about these financial statements is like they're the company's diary. I know, they can look kind of boring and dense, just pages and pages of numbers, but trust me, if you know the code, they tell you everything, the good, the bad, and the ugly.
So what's our main tool for cracking this code? It's something called financial ratios. Think of them as your magnifying glass. They take all that confusing, overwhelming data and boil it down into simple, powerful clues that we can actually use. They let us see what's really going on.
First things first, we need to look at the profit engine. You know, the heart of the whole operation. The big question is this company actually any good at making money? It sounds basic, but it's absolutely the most important place to start.
And our first big clue is a powerhouse called Return on Capital Employed, or ROCE for short. Now this one it's just brilliant. It asks a really smart question. For all the money that's been put into this company, from shareholders, from loans, you name it, how much profit is it actually spitting back out? It's the ultimate test of efficiency.
So let's open up a case file. We've got ABC Limited. The file says they've got sales of $5 million, a trading profit of $1.5 million, and $7.5 million in capital employed. We do the math. Profit divided by capital, and boom, we get an ROCE of 20%. So, what does that 20% actually tell us? Is that a good clue or a bad one?
Well, a high ROCE, like that 20% we just saw, is a fantastic sign. It tells you management knows exactly what they're doing. It's like a finely tuned engine, turning every dollar of capital into solid profit. But a low ROCE? Oof, that's a huge red flag. It's telling you the company's just not using its money wisely. The engine's sputtering. So ROCE gives us that high-level view of efficiency. But we can zoom in even further with another tool, the net profit margin. This one is all about the bottom line. It asks, after you pay for everything, salaries, rent, materials, taxes, the whole shebang, how many cents of profit are left from each dollar of sales? It's the real nitty-gritty of profitability. But hold on. A company can look super profitable on paper and still be a total house of cards if it's buried in debt. So for our next move, we're going to take a peek at the balance sheet. We're hunting for signs of danger.
And the tool for this job is the interest cover ratio. I really like this one because it's so direct. It asks a very simple, almost brutal question. Can this company actually afford to pay the interest on its loans? It just divides the profit by the interest bill and tells you how many times over they could cover it.
And the verdict from this test is usually pretty black and white. If the number is, say, above 2, you can probably breathe easy. They've got a nice safety cushion. But if it drops below 1.5, that's when the alarm bells should be going off. It means even a small dip in profits could mean they can't pay their lenders. And that is a really bad spot to be in. Okay, so we've looked at profit and we've looked at debt. But you know the old saying, cash is king. A company can be profitable and still go bust if it runs out of actual cash to pay its bills. So our next test is all about survival. Can this company handle a sudden cash crunch?
The first most basic check we can do here is called the current ratio. It's super simple. It just takes all the stuff the company can turn into cash within a year, its current assets, and compares it to all the bills it has to pay within that same year. If the number is over 1, great. In theory, they have enough to cover their short-term bills.
But what if things get really tough? That's when we bring out the big guns, the liquidity ratio, also known as the acid test. And it's called that for a reason. It's way tougher than the current ratio because it does one critical, very skeptical thing. It completely ignores all the company's inventory. So why would we do that? Why ignore all that stuff? Well, think about it. If a company is in a panic, a real fire sale, and it needs cash right now, can it really sell all its stuff at full price? Probably not. The acid test tells you if the company could pay its bills even if it couldn't sell a single widget. It is the ultimate real-world pressure test. Okay, you ready for some next-level detective work? What if you could take a bunch of these clues, profitability, debt, liquidity, and combine them into one single powerful score? Well, you can. It's called the Altman Z-score, and it's basically a formula designed to predict the chances of a company going bankrupt.
And what's great about the Z-score is how clear the verdict is. If the score is above 3, you're in the safe zone. The company's likely fine. But if it's below 1.8, you're in the distress zone. That's a huge warning sign. And anything in between, well, that's the gray area. It means we need to put our detective hat back on and keep digging.
All right, so we've chucked the profit engine, we've looked for debt traps, and we've pressure tested its ability to survive. Now for the final piece of the puzzle. What does the rest of the world think this company is worth? It's time to crack the code of the stock price.
And the foundation for all of this is a number called earnings per share, or EPS. All it does is take the company's total profit and divide it up by the number of shares out there. It literally tells you, for one single share of this company that you own, how much profit did it earn. It's the most basic building block of value. Now, once you have EPS, you can calculate probably the most famous ratio in all of finance, the price-to-earnings ratio, or PE. You just take the current stock price and divide it by that EPS number we just talked about. And what this tells you is incredible. It's basically a snapshot of what the market thinks about the company's future.
So if you see a really high PE, it means investors are super excited. They're expecting massive growth, and they're willing to pay a lot for it today. Now that could mean it's an amazing growth stock, or it could just be way, way overpriced. On the flip side, a low PE means the market is kind of pessimistic. Maybe it's an overlooked bargain, a value stock, or maybe it's cheap for a reason, a value trap. See, the PE ratio never gives you the final answer. It just tells you which question you need to ask next. And that's really the magic of it. When you start putting all these ratios together, you realize they're not just math problems, they're clues. They're telling you a story about the company's past, its present struggles, and its future opportunities. It's the language of business, and now you know how to speak it.
So that's it for our first investigation. We've just handed you the Financial Detectives Toolkit. You now know how to find the clues and how to read them. The only question left is, what story are you going to uncover?